I think we're going to go into a full-fledged precious metals bull market, and after that, a full-fledged natural resources bull market. Honestly afraid that gold will go much higher. I don't own gold because I think it'll go from 2,500 to 3,000. I
Exactly.
own gold because I'm afraid it'll go to 9 or 10,000. Is this a prediction? No, it's a fear. But let me give you the math, not the narrative behind the fear. The U.S. economy, and I'm a U.S. citizen, so of course I'm U.S. centric. The U.S. economy is 23% of the world's savings and investment market. While the U.S. is becoming less prominent, it's still hegemonistic. And the arithmetic around the U.S. economy is scary. At the federal level, our on-balance sheet liabilities exceed $35 trillion.
Recent analysis shows we're entering a significant bull market for precious metals, particularly gold, which they see potentially rising to $9,000 or $10,000. This isn't just a prediction, it's a fear driven by economic concerns. The U.S. economy, while still dominant, accounts for 23% of global savings and investments, but faces serious challenges. Their federal liabilities exceed $35 trillion, and even more alarming is the net present value of off-balance sheet liabilities, which remains unfunded. This financial instability fuels their fear of gold's skyrocketing value. The speaker RickRule, a respected investor and financier with a focus on precious metals and mining, suggests to increase cash holdings and reduce equity exposure. While they have a substantial cash position and a gold-centric portfolio, they are looking for attractive investment opportunities. Recent developments highlight a substantial increase in cash positions among major investors, notably Berkshire Hathaway. In the second quarter of 2024, the company reported record cash and cash equivalents of approximately $277 billion. However, they acknowledge the downside of holding cash, as inflation erodes purchasing power. With the real yield on U.S. Treasuries low due to rising inflation, RickRule exposes they're effectively losing money on cash. Yet, they believe maintaining liquidity during market downturns allows them to seize opportunities when others cannot, viewing the negative real yield as a premium for that flexibility. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
I think that depends on how much work you're willing to put into things and how opportunity constrained you are. I'm trying to allocate cash right now. I have too much cash. A wonderful problem, by the way. If I were a normal human being, I would probably buy more gold, but I've been buying gold since the year 2000, actually since 1998. And I have a gold-centric portfolio. I don't need to buy more gold. What I am trying to do is increase my risk-on positions. The difficulty with that is that the private placement opportunities that I'm seeing aren't sufficiently attractive to induce me to part with my money. Specifically, I'm not getting very many warrants. And I love warrants. If you want me to speculate, you have to make it worth my while to take the risk. I'm also actively engaged in trying to increase my position in convertible preferreds in circumstances where I give up some of my upside in return for eliminating most of my downside. The one area where I have been able to deploy capital, and this isn't available for most investors, is I have been able to buy privately tranches in the senior secured revolving credit facilities around major oil and gas and natural resource companies. Think of these as very high quality 366-day bonds. And I have been increasing my position in that because they've been available to me very, very aggressively. But I still have, by traditional standards, too much cash. For most people, the arithmetic involving cash is as follows. On a current basis, you are losing money. If, as an example, in the US dollar, you're in the benchmark savings instrument in the world, which is the US 10-year Treasury, the US government is paying you 4%. If you believe that the degradation of your purchasing power is accounted for by the CPI at 2.6%, you're making a 1.4% real yield, which in a historic sense isn't bad. If you believe, like I do, that the real deterioration of the purchasing power of the US dollar is about 7.5% compounded, it means that holding cash is costing you 3.5% of your purchasing power every year, which is not good. I stomach that because I have lived through several market panics in my life. And during those market panics, if I had liquidity when nobody else had it, I had both the tool and sometimes the courage to deploy that capital when nobody else was deploying theirs. In other words, I was able to take advantage of a market decline rather than being taken advantage of. And I regard the negative real yield on my savings to be an option premium. on having the ability, having the access to that capital, while the U.S. is becoming less prominent, it's still hegemonistic. And the arithmetic around the U.S. economy is scary. At the federal level, our on-balance sheet liabilities exceed $35 trillion. But much more scary than that is the net present value of our off-balance sheet liabilities. Unfunded Social Security, Medicare, Medicaid, government worker pensions, military pensions. That number, not the aggregate number, not the number over time, but the net present value of unfunded liabilities exceeds $100 trillion. So the aggregate liability of the U.S. citizenry expressed by the federal government is $135 trillion negative. And that number is increasing by $2.5 trillion a year in the on-balance sheet liabilities.
Recent estimates suggest the U.S. has $5 trillion in off-balance sheet liabilities, while federal revenues are only $4.6 trillion, resulting in a deficit exceeding revenue by more than 2 to 1. To address this, the Speaker RickRule identifies two potential solutions: means testing Social Security and inflating away the net present value of obligations. They recall how in the 1970s, the U.S. used inflation to reduce the real value of its debts, leading to a dramatic increase in gold prices. They predict that a similar approach may occur again, causing gold to become a key asset as the purchasing power of the dollar declines. The Speaker RickRule notes that silver hasn't appreciated as much as gold. They believe that if the narrative around precious metals continues to gain traction among general investors, silver could see significant interest. While gold may outperform silver in the short term, they speculate that silver has the best chance of doubling in value over the next 5 years. The Speaker RickRule highlights two undervalued gold companies, Galliano Gold Incorporated and Gold Mining Incorporated, with Tier 1 deposits priced below 50% of their net present value. These deposits promise long-term production and strong returns, historically outperforming the market with less risk over 5 years.
Recent estimates suggest $5 trillion a year in the off-balance sheet liabilities. Now, the aggregate revenues, the total revenues of the federal government are $4.6 trillion a year, which is to say that the deficit that we're incurring on an annual basis exceeds our revenues by more than 2 to 1. How do we get out of this circumstance? There's only two ways that I can think of. You change the nature your payments, which is to say you means test Social Security, you reduce the benefit, you change the year that people accrue it, which will wreak real hardship in the U.S. economy, and likely you inflate away the net present value of the obligation. What the United States did in the decade of the 1970s is via inflation, they inflated away 85% of the net present value of their obligations. They devalued the U.S. dollar in terms of purchasing power by 85% over 10 years. That coincided with an increase in the gold price from $35 an ounce, admittedly price controlled, to $850 an ounce. What I'm telling you in a very long-winded fashion is that if past is prologue, the U.S. government will have to do again to the purchasing power of the dollar what they did in the decade of the 1970s. And it is likely to me that the financial asset that people will turn to as a consequence of the deterioration of their purchasing power in U.S. dollar savings will be gold. I think you probably look at silver. Silver hasn't kept up with gold in commodity appreciation because the buyer in the market has been a fear buyer. It's primarily been central banks. If the precious metals narrative continues to the generalist investor, if past is prologue, when the generalist investor comes into the precious metals market, they come into the silver market. I'm not saying, by the way, that silver is going to run anytime soon. I think that gold will for a while continue to outpace silver. But if I were to speculate on which commodity has the best chance of doubling, that would be silver. If you give me 5 years, that's a different circumstance. That's North American natural gas. It's worth $8 on world markets. It sells in the U.S. for $2.25 and in Canada for $1.50. But there's also two gold companies that we might look at. It's odd that a material in as much good favor as gold might offer up Tier 1 deposits, selling at less than 50% of indicated net present value, with the potential for multi-decade production in the best quartile with regards to all-in sustaining capital costs and the best quartile with return on capital employed. It has been my experience that these tier one deposits over 5 years substantially outperform the market with less risk.
The speaker presents a compelling case for the potential rise of precious metals, particularly gold, in light of economic uncertainties and rising liabilities. With silver also positioned for future growth and attractive investment opportunities in the energy sector, investors should stay vigilant and consider strategic allocations in this evolving market. What specific factors could trigger a shift in investor sentiment towards silver in the coming years? Share your thoughts in the comments below. We'd love to hear from you. If you found this video useful, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.